ever wondered why your financial health and credit score matter? Or how you can improve them? Knowing the answers to these questions can be a game changer. Financial health and a good credit score are the foundation of financial freedom. They can open doors to better loan terms, lower interest rates, and even job opportunities. This video will provide you with easy and manageable steps to boost your credit score. So, are you ready to take control of your financial future? Let's dive in and uncover the secrets to a better credit score. Before we delve into the how, it's crucial to understand the what. So, what exactly is a credit score? Simply put, a credit score is a numerical representation of your credit worthiness. It's calculated based on your credit history, which includes your borrowing, repayment, and current debt. Lenders use this score to determine whether or not they should lend you money and at what interest rate. A high credit score indicates that you are a low-risk borrower, which could mean lower interest rates and better terms for loans and credit cards. On the flip side, a low credit score can limit your borrowing options and make borrowing more expensive, so it's not just a number. It's a key factor that can shape your financial future. Now that we know what a credit score is, let's move on to the steps you can take to improve it. First things first, always keep an eye on your credit report. Now, you might be wondering, why is that so important? Well, your credit report is like a financial report card. It tells lenders how responsible you've been with your money. It's the key to getting approved for loans, renting an apartment, and sometimes even landing a job. But, like anything else, your credit report isn't perfect. It can have errors, from simple typos to serious mix-ups like someone else's debts on your report. And these mistakes can cost you, lowering your credit score when you've done nothing wrong. So how do you prevent this? Regularly check your credit report at least once a year. If you spot any inaccuracies, don't panic. You can dispute them. It might take some time, but correcting these errors can boost your credit score significantly. Keeping track of your credit report is a simple first step towards improving your credit score. The second step is a no-brainer but often overlooked. Pay your bills on time. Yes, it's that simple. Late or missed payments can leave a negative impact on your credit score. It's like a red flag for lenders signaling that you may be a risky borrower. So, how can you ensure you're always on top of your bills? Here are a couple of tips. First, consider setting up automatic payments. This way, your bills get paid before you even have a chance to forget about them. Many service providers and banks offer this feature, so it's just a matter of setting it up. Second, use reminders. There are plenty of apps and tools that can help you remember your due dates. Or even a good old-fashioned calendar can do the trick. Remember, consistency in bill payments can significantly boost your credit score. So, make timely payments a priority and watch your credit score climb. Our third step might surprise you. Keep your credit card balances low. You might be wondering, why does this matter? Well, it's all about something called credit utilization. This is the ratio of your credit card balance to your credit limit. So if you have a credit limit of $5,000 and you've spent $2,000, your credit utilization is 40%. Credit bureaus, those folks who determine your credit score, they don't like it when your credit utilization is high. They view it as a sign you might be living beyond your means. It's recommended to keep this rate below 30%. So how can you keep your balances low? Well, try to pay off your card in full each month. If that's not possible, at least make the minimum payment. Consider setting up automatic payments to avoid forgetting. Remember, maintaining low credit card balances is a surefire way to improve your credit score. Lastly, don't close your unused credit cards. You might be thinking, why should I keep a credit card I'm not using? Well, here's why. One crucial factor that goes into calculating your credit score is the length of your credit history. The longer you've been managing credit, the better it is for your score. Now, when you close an old unused credit card, you effectively shorten your credit history. It's like erasing a chunk of your financial track record, and it could potentially lower your credit score. Additionally, closing a card reduces your available credit. This could increase your credit utilization ratio, which is the amount you owe versus your total credit limit. A higher utilization ratio can also lower your credit score. So, even if you're not using a card, it's worth keeping it open. It's an easy way to preserve your credit history and keep your credit utilization ratio low. By keeping your old credit cards open, you can potentially improve your credit score. Improving your credit score doesn't have to be a daunting task. Remember, keeping a regular check on your credit report, paying your bills on time, managing your credit card balances, and not closing unused credit cards are the 4 key steps. These simple yet effective hacks can significantly boost your financial health. Remember, a good credit score can secure your financial future. Don't forget to like, share, and subscribe for more financial hacks.